Well, the volatility continues. This time, the stock market closed up over 1%, so yet another 1% up or down day. We've had a lot of those here recently. And after hours, my goodness, just took a peek at Amazon and noticed I was up almost $100 per share off of their earnings announcement. Intel up after hours as well, so maybe some positive vibrations going into tomorrow morning's open. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's April 26th, 2018. If you're new to these videos, first of all, thank you for joining us here tonight. I hope you find value out of them. Remember, you can always subscribe to our YouTube channel by clicking that red subscribe button. Some of you will also find our company logo floating in the lower right-hand corner of YouTube, and you can subscribe through that as well. If you get value out of these videos, we would encourage you to click thumbs up. We always appreciate that, and it lets us know that you want us to continue to do these on a daily basis. In addition to that, you're welcome to leave comments for us by scrolling down below on YouTube. And then lastly, in our description area, we do have some various links that will allow you to sign up for our email distribution list, which will then entitle you to not only getting the link of the video sent to you nightly, but in addition to that, we also have some nice goodies in there with the bullish and bearish clusters within the S&P 500. Now, in addition to YouTube, we're both heavy users of Twitter. My handle is at Brandon Van Zee. I would encourage you to follow me there. We generally pin the tweet for the Market Outlook video to the top of our timeline, so it's nice and easy for you guys to find. All you have to do is just visit my profile there on Twitter, and you'll find it right up there at the top. And you guys did a great job for me last time. Thank you very much for that. I think the last I checked, there was like 138 likes. And like I always tell you in this video, as long as we're up over 100, I've got no complaints at all. So you guys are doing a great job there. Please make that a habit if you enjoy these videos. Now, in addition to Twitter, we also have a presence on Facebook. In fact, we just pushed past 1,000 subscribers within our Facebook group as well. So if you happen to be involved in that particular social media network, we would encourage you to join forces with us there. All right, with that, let's go ahead and jump into our market analysis here for the day. As you can see, I've got the S&P 500 pulled up in front of us. And again, we were up by 1% here today, 1.04% to be precise. And you can see how the candles kind of look. We had a nice two-day rally right there. Now, before we get too excited about it, let's keep in mind that the intermediate posture remains bearish at this point. That's why we have this darker red background color right here to signify that. Now, if you can't see that, if you're colorblind or something along those lines, remember you can still read the green line down below to determine your posture as well. But basically, what this tells us, we're still strongly bearish. Reason for that is the green line is still pushing lower beyond and past the 50 percentile. So at this point, you can see in this label over here, it says the intermediate line is at 42.31 and falling. In addition to that, we do have that moving average line painted red. Now remember, that's not one in the same as the posture of the market forecast itself. It's one additional feature that you can think about as you're determining your next best trade. And right now what that's telling us is that the path of least resistance for the market continues to be to the downside. So we don't want to make too much of this type of a move here, but it is good to see that the bulls aren't going to give up without a fight. And obviously, as mentioned before, with Intel and Amazon up so big after hours today, it might very well lead to a strong open in the morning, which could follow through with more bullishness. So we'll continue to keep our eye on the story. But as you can tell by this 3-month chart we have in front of us, it's been chop and slop since February. This has not been a trend trading market. So keep in mind that when you're setting your postures based off of trend trades, which is what we do here with the market forecast video, you're often going to find whipsaws if the market ultimately goes sideways. And that's what we've had. You know, as I've been saying since February, this is an environment, until proven otherwise, where we're buying the dips and selling the rips. And I continue to believe that until we break out above 28.72 on the upside or break down below 25.32 on the downside. Sorry, did I say that wrong? 28.72 on the upside and 25.32 on the downside. I'm going to assume that this will be a choppy, sloppy market. And so these are markets where you might be better off being a little bit more agile. placing swing trades rather than trend trades. Could also be a good market to be selling premium in by selling spreads or iron condors or different things like that, since we do have above average levels of volatility, at least in comparison to recent years here. Of course, for those of you that are long-term investors, there's always opportunities out there as well. Today in my dividend growth investing class, as an example, we covered 2 different companies that have dividend increase streaks that are more than 50 years in a row of dividend increases, and both of them have sold off to levels that would be generally attractive to longer-term dividend-oriented investors. Remember, if you're a premium market scholar subscriber, I would invite you to join me in that class every Thursday. Let's go ahead and take a look at a few more charts here. So let's go ahead and go to our 4 grid, where we can see the market forecast presented on the 4 different major indices in the United States. So let's take a brief look at which indices did the best here today. And you can see it was the NASDAQ. Now, I think it was Facebook that was out with earnings here in the last 24 hours that really boosted the NASDAQ today. But again, after hours, you know, Intel and Amazon and others are probably going to boost that NASDAQ again tomorrow morning. You will notice that the NASDAQ was up 1.64% today. But again, similar to the S&P 500, we remain in a bearish posture using that intermediate term line, that green line on the market forecast down below. You'll notice that the only one of the 4 that currently has price above a moving average is the Russell 2000. That's your chart in the lower right-hand corner right here. And you can see it's kind of an interesting chart setup right there, where we went up and through that 30-day moving average. We pulled back to it. It is finding some stabilization right there, and now it appears that it wants to bounce off of that. In fact, you have a bit of a Cahold candle shaping up there. For those of you that haven't heard that term before, just a close above the high of the low day, with yesterday being the low day and today us closing above yesterday's high. That's generally a positive sign. Who knows, maybe we've got a bounce in store for the Russell 2000. Let's go ahead and take a look at our next chart setup here. And this is going to be our 3 green arrows chart setup. When we're looking at this particular chart setup, we're looking at the colors all the way to the right to determine whether we have 3 green arrows, 3 red arrows, or a mix of green and red arrows. And as I look at this right now, I actually only see one that has 3 red arrows, and that's your NASDAQ at this point. Remember, if NASDAQ closes above its 30-day moving average as soon as tomorrow, which is entirely possible, then you would get one of those green arrows back. But right now, the NASDAQ does have that arrow right there, another one right there on the MACD, and then, of course, another one down below on the stochastics. The rest of the charts have a mix of green and red arrows, so maybe a little bit more neutral types of charts on the other 3 indices. Let's take a look at our next setup here. And, whoops, I clicked on the same one. Let me try that again. Here we go. This is our longer term chart setup. Remember, this is our 1040 crossover method. So this is a chart that is kind of a longer term mentality as well, where you're not anticipating a lot of activity. So the last time we had any activity with this type of a strategy was over 2 years ago at this point, when we had these bullish crossovers where the chart went from this pink color to the green color. And that occurred when we had the moving averages themselves cross over. Now, for those of you that aren't familiar with this setup, what we're using here is a 10-period exponential moving average represented by the orange line, and then the blue line is going to represent your 40-period exponential moving average. And we're just generally looking for crossovers themselves. It's been a long time since we've had one, so we don't spend a lot of time belaboring the point, but just be aware from a longer term perspective, we remain bullish at this current time. All right, let's go ahead and do a little bit of 12 grid analysis now. So let's go to our intermarket analysis 12 grid. And for this, I do have to cut that camera feed so that way you guys can see every square inch of my screen here. A couple things stood out to me from the Intermarket Analysis 12 grid today. First of all, notice down into the lower left-hand corner, that's your US dollar there. Now, I'm plotting that out using UUP. You can also use /DX on the Thinkorswim platform if you so desire. But this UUP is a good, at least, barometer of how strong or weak the dollar may be versus a basket of other currencies. And you can see we had a really strong candle here today on UUP. Remember, if you ever needed to look at that in better detail than is allowed for on a 12 grid like this, I can just right click and then go to maximize sell, and then you can see that nice and big there. And you can see that the green line, the intermediate line, the one that we focus on the most here in the market outlook video, is going to show us or exhibit bullishness at the current time. Now, it's exhibited bullishness since it basically bottomed out right there on April 17th. So starting with April 18th, we've had a bullish bullish posture on the US dollar. So kind of an interesting candle there today that completely engulfed that prior candle that a lot of people would have led to believe that it would have been some sort of indecision type of a candle. That's that style of a candle that you see there. But boy, there was no indecision amongst traders' eyes today. That was all aboard to the upside type of a candle on the US dollar. And of course, that can then have reverberations across some of the commodities markets and also some of the interest rate markets as well. Now, speaking of interest rates, one area that I think is of interest, and we'll be talking about it a little bit more on our trade application example, but it's these two charts right here. So it's the second chart on the top and the chart directly below it. Now, I put those two right next to each other so they'd be easy to talk about together because they're really kind of like that Rorschach test when you kind of that ink block test. They kind of look like they're the opposite of one another. The top chart there represents your 10-year U.S. Treasury yield, and then the bottom chart there represents TLT, which is your government long bond, which is actually a little bit closer to a 20-year bond, but you get the picture. Basically, when interest rates go up, like we've seen right here on this top chart, then prices of bonds go down. Well, many of you are aware that within the last 3 days or so, we finally hit a 3% 10-year Treasury yield for the first time in about 3 or 4 years. And that initially caused a lot of negative activity within the stock market. But it is interesting once we hit those types of levels, how does the market react to it? Does it blast right through it, or does that kind of reset the deck and represent a new kind of congestion zone? And that's what I'm wondering is happening right here. You can see that we popped all the way up here on TNX, and then today we actually had a kind of a mini meltdown. We were down 1.12% on that, and you can see that would be the opposite of a hold. That would be a close below the low of the high day in that case. And again, it can be representing a bounce opportunity of sorts. In this case, in the case of yields themselves, a bounce down. In the case of bonds themselves, down below with TLT, a bounce up. There we do have our hold. And not only that, but yesterday represented a bullish cluster day for TLT. So we'll review that here in just a little bit when we get into our trade application example once again. But before we do, let's go ahead and take a look at a couple of more charts here. Let's take a look at our foreign markets 12 grid at this point. And you can see here that we've got 3 of the foreign markets that currently have bullish postures. The rest are bearish. The 3 bullish ones are India up here, the 3rd one up from the top. We also have Japan, the 4th one in the middle row there off to the right. And then we also have down below the United Kingdom. The United Kingdom has been the one that's been the most consistently bullish. Japan and India have kind of started to stabilize and just started to become bullish. So it hasn't been confirmed quite as much on those other 2 charts. In fact, in the case of India, you'll notice that its moving average continues to be red there. Again, if we right-click, go to maximize sell, you can kind of see that in a little bit better detail right there. So yes, we did have this green line barely go higher. It's now at 42.50 and rising, but as you look at that green line with your naked eye, it does look more flattish than actually up. So I wouldn't necessarily assume that this is going to be a hugely robust chart going forward, again, particularly since that moving average continues to point a little bit lower. Now, on the other hand, we look at it, the other 2, you look at Japan, it's a little bit better because it's got that yellow tail to its moving average. So let's right-click, go to maximize sell there. So there, it's a little bit of a better sign. We have price above that, that kind of flattish moving average at this point. We also have the intermediate line almost bumping into the upper reversal zone there, which we would consider very bullish as well. It's at 79.93 and rising. Remember, anything above 80 is that upper reversal zone. So Japan is stabilizing. Again, it's not the strongest looking chart, but in context of what's happening with markets around the world in the last couple of weeks, it's holding up better than others. So from a relative performance perspective, it is doing reasonably well. But of the 3, it does seem like down below here, EWU, so let me maximize that. This is the United Kingdom. This one probably looks the strongest of all of them. So this one, of course, does have the bullish intermediate term posture as well, according to the market forecast indicator, but it also has this green moving average tip. So remember, it's kind of an interesting example of 3 different countries today that are bullish. One of them had a red moving average, one of them had a yellow, and this one has the green. And that's telling us that the moving average itself is rising and price is above that rising moving average. Notice that we did have a hold on this candle here today as well, as this would have been the most recent low candle, and clearly we closed above yesterday's high in this particular case. So keep your eye on the United Kingdom. It's actually showing some resilience in this market. The rest of the foreign markets are struggling at this point. But again, things can change in a hurry, especially during earnings season. So we'll keep our eyes on the charts. For our sector discussion, let's rather than doing the sector 12 grid, let me show you the sector comparison 1 grid. As many of you are aware, I've spent the last couple of weeks building out a whole bunch of charts. As you can see here, there's about 19 or 20 of them that those of you that are Premium Market Scholar subscribers are going to have access to here within the next couple of days. So look forward to receiving an email from me on that. But one of the things that I did was, rather than just having the sector 12 grid like I usually show you in this particular video, I also built a sector comparison line chart here because I know David likes to look at that a little bit more often, so he'll be able to use this going forward a little bit more as well. And you can see that the way that I've set this up here, first of all, this is a 1-year chart to start with, just in case you're wondering the time frame. Of course, we can change that to whatever time frame we want. But you can see the nice thing about this chart, first of all, you can see the colors do pop out fairly nice for you. Now, keep in mind when we're dealing with 12 different colors here, it's never going to be perfect. So I'm not expecting perfection out of this, but I do think that the colors pop out decently enough where you can make some distinctions in here. In addition to that, notice that as an example up here with this red line, that's XLK technology, it actually puts the label of that ETF on there for you. So again, you don't have to memorize colors or anything. You can just read the label and say, oh yeah, I know XLK is technology. Now, if you don't know XLK is technology, I did take it one step further and I did color code it with labels up at the top as well. So you can see up here as an example, in the red label, it says technology. So anyway, a couple of additional features there to hopefully make your guys' lives easier, those of you that will end up using these charts a little bit more often. So from the last year's perspective, we can see technology has been the runaway winner. It's up about 22% in the last year. On the downside, we actually have telecom, which, boy, it struggled today again. Some of you may have noticed that AT&T came out with earnings, and the market wasn't quite as nice to them as they were to their chief competitor Verizon's a couple of days ago. AT&T struggled today, but telecom itself is struggling over the last year, down about 20%. And then, of course, you've got these interest rate sensitive areas that are all near the bottom. XLP, which is the staples. You've got XLRE, which is the REITs, and then XLU, which is the utilities. And so it's no surprise to me that the 4 bottom sectors right now are those that offer the juiciest dividend yields. And again, it all comes with context. What do you know about interest rate sensitivity, right? In this macro environment where interest rates are rising, those types of securities will likely struggle on a relative basis compared to some of those other areas like technology that's not overly known for paying dividends. If we were to kind of zoom in on the last 3 months, it might paint a slightly different picture than a 1 year. So let's do that now. And you can see that indeed that's the case. Now, somewhat surprisingly, we do have the 2 defensive areas of the market on the bookends of the last 3 months. We have the utilities actually leading the way and the consumer staples companies on the downside. So it's kind of an interesting dichotomy there. And you can see that most of the other sectors are kind of bunched up right around the S&P 500. Now, the S&P 500 on this chart is going to be represented by this dark gray or black line right here. So you'll often find that it's directly in the middle of the pack. And that makes sense because, of course, the SPX is made up of all these other securities that make up the rest of the ETFs from the sector perspective here. So over the last 3 months, our outperforming sectors are going to be utilities, energy. Now, of course, David and I have been talking about that time and time again in these videos, that energy has been a leading area of this market recently. In fact, we've got some positions in our portfolio with Schlumberger and Halliburton doing reasonably well based off of that. We have technology, which is kind of sneaking in there in the red. Then in that turquoise line right there, that's real estate. And then we have consumer discretionary as well. So those are kind of your leaders from a 3-month perspective as it stands right now. Let's see if there's anything else of interest to take a peek at here today. You know, it might be worthwhile spending some time on that volatility chart again that I showed you guys on Tuesday. Reason for that is we had another 1% day. And I kind of like looking at that new indicator on my chart. If it'll pull up for me, there we go. Right down here, that will show us, so you can see from the labels, the blue line will represent a 1% move. The orange line will represent a 2% move. Let me pull up the SPX in this particular case. And you can see that this candle that's associated with today's candle in the green right here is popping right up to that blue line. And again, that blue line represents a 1% move in the market here today. And of course, 2 days ago, the last time I did this video, we had a 1% move to the downside. And that's what that red candle was showing us right there. So again, this last 2 or 3 months right here, look at how wide those particular candles are. Lots of 1% and 2% moves, especially in comparison to what happened, you know, 9 to 10 to 11 months ago, where it was relatively quiet. So we have been in a more volatile environment, and I would assume that will likely continue until it doesn't, right? And we're waiting for a breakout in either direction to kind of determine that. So anyway, more volatility there out of the market today. And then lastly, let's take a quick peek at that yield curve as well. So again, the yield curve is going to be, the way that I've got this set up by default, I kind of changed it since the last time I showed you guys this on Tuesday. I did change the default setting to 20-year monthly. And the reason for that is, you know, as a teacher, I want to be able to show you, you know, interesting points that you can kind of tuck away in the back of your mind and understand how do you react to these various events that might have happened in the financial markets. And so a lot of you have heard that term inverted yield curve before, but you maybe don't have a real good image of what that looks like in your head. So I think that this particular graph does a good job of that. First of all, up at the top, like I explained to you guys on Tuesday, these represent the different maturities of the U.S. government treasury bonds. So, and you can see those different maturities up here at the top with their labels in case you need to see that. And if you hover your mouse over each one of them, like right there is that black label. Notice that off to the right here, it's not showing you a black bubble. And the reason is because it's kind of getting in the way with these other bubbles. So if you hover your mouse over the black line now, like I've done, not only does it make that black line really stand out for you on the chart, but it'll also show you that the interest rates are exactly at 3% as it stands right now on the 10-year. So you can see that these are all rising, like I mentioned on Tuesday. But one thing that you can't tell by just looking at the rising lines is whether the spreads are widening out or they're getting tighter. And so the yield curve is actually flattening out right now. And that's why I've got this kind of additional level built into this chart down below. This is your 2s versus your 10s, or your 2s minus your 10s, or your 10s minus your 2s. I can't remember. I always hear Rick Santelli saying that on CNBC. I should pay more attention next time. But anyway, this is your 10-year, 2-year Treasury yield spread. And what this is telling us here is that when we have a downtrending 10s and 2s spread, it's telling us that the 10s and 2s interest rate are getting closer and closer to one another. So as it stands right now, the difference in that spread is 52 basis points. And you can read that right here in my label itself if it's a little bit harder to read over here. You can also adjust this a little bit better down below if you want to see some more increments here rather than just 1, 2, and 3. So I can kind of drag that up and you can kind of see it's right around that 0.52 right there. So remember, in order to see an inverted yield curve, the last time we had that was back in 2006 and 2007. And that's why this lower subgraph can really help us kind of interpret and understand that from a visual perspective, because the spread, the difference between the 10-year and the 2-year, inverted. And that's what's happening when this blue line is crossing underneath of this purple line down below. You can see it inverted for a large portion of 2006 and into early 2007. It also inverted back here during the dot-com bubble. Generally speaking, an inverted yield curve is a bad thing for the equity markets. But the interesting thing about it as well is that sometimes there's a delayed reaction. I know I've heard David Settle mention that during these videos before as well. You know, you guys will recall that the bear market in stocks actually didn't really start in earnest until 2008. So just because we got the inverted yield curve in 2006 doesn't mean that that would have been the best time to be selling stocks because there was a bear market right around the corner. You actually had to wait a year and a half to potentially 2 years before you really saw that unwind. So it's not an automatic sell signal. It's just a heads up that things maybe are not as rosy as they could appear. So we're going to keep our eye on that. And of course, if we ever do get an inverted yield curve, you guys are going to be the first to know if you're watching these videos on a nightly basis. All right, so that then brings us to our trade application example for the day. Let me go back over here to just a normal options chart here. And I'm going to pull up TLT. So TLT, most of you are aware, very liquid security. It's a company that, or not a company, an ETF that tracks the long bond here in the United States. It has a tremendous amount of liquidity. You can see that its volume here today, as just an example, in the ETF itself was 6.5 million. And if you look at their options chain, it's generally quite liquid as well. So the reason I'm attracted to it today, or the reason I think it's interesting, and by the way, this market maker move is kind of getting in my way, so I kind of reset up the think script so that way we can easily get rid of that if it's in our way and it's clouding our view. So if you just go up to the yellow lines there that represent the upper and lower bands of the market maker move, I'm just going to right click on that and remove study and say yes, and then that should go away. There we go. So now we can see that a little bit better. Of course, you can get rid of those bands as well if you don't like that probability cone. So let's remove that as well, just to show you guys a little bit of functionality there where you can clean up your screen a little bit to see the price action. But again, the main point for me of why this looked interesting was because of all this talk about the 3% 10-year, and then today immediately seeing that bond prices are actually rallying, you know, basically a day after hitting a 3% yield, or 2 days after. Not only that, but it's helpful that we've got a bullish cluster, and of course that occurs when we have the red, the green, and the blue line on the market forecast indicator in the lower reversal zone on the same day. Remember, that's a sign of an oversold market, and TLT generally does pretty well when it has these bullish cluster signals. You can see they had a few of them over here, and for the most part, the bleeding did stop as we started getting a few of those signals. And so if you were to do something reasonably bullish, maybe not out and out wildly bullish, but reasonably bullish, you can do reasonably well with that trading idea. So we're going to try that again here, and we'll see how it goes for us, but we're going to do a bull put spread on this. And we've got a nice horizontal support level down there. We have a hold in our candle today where we closed above the high of yesterday as the low day. So a lot of good things going on there with that chart, as long as you don't think that interest rates are going to skyrocket from this moment forward. And so let's go ahead and take a look at what the strikes suggest. I'm going to come over here to the trade tab. And the other nice thing about TLT, by the way, is you don't have to worry about any earnings coming out and destroying your trade like that might have happened with folks with Chipotle or Intel, or as I mentioned, Amazon. Holy mackerel. Amazon is up at $611 right now after closing at $15.17, and I should remind you that $15.17 itself was up 57 bucks in today's normal session. So that's $100 basically tacking on to that $50 move it already had. Now, of course, many of you that attend my trend trading classes know that we own 9 whopping shares of Amazon. I like to use it as an example because we don't have to feel like the big man on the campus that has to own 100 shares of everything that we get into. It's a reminder that, yes, even 9 shares can be a very impactful thing to your portfolio when you're up $100 per share in the after hours. So hopefully we see some good vibrations from Amazon in the old trend trading account tomorrow. But for tonight in the market outlook video, again, we're going to focus on a more subdued type of a trade. One that doesn't require a tremendous amount of directionality. It's called a bull put spread. And this is on TLT, so I've got that pulled up right here. And as we come over here to the right-hand side where we've got the puts, generally where I start my process is looking for a 30 delta, and we've got one spot on over here. That's your 116.50. And we've got a reasonable enough amount of liquidity there, only 5-cent differential on the bid and the ask, so it's good enough for me. I'm going to go ahead and right-click on that, and I'm going to go to Sell Vertical. And I'm going to change this because I don't like to have 50-cent wide increments here on my spreads. It just would create a situation where you'd have to do way too many contracts to make it worth your while. So I'm going to start by going out just $1 wide. So that means rather than buying the 116 put, I'm going to buy the 115.50 put. Now, unfortunately, you can see right here what that's going to do. It's going to create a situation where our credit is only 22 cents. So, generally speaking, what I like to do is get 30% return on risk. This is going to be just a little bit shy. Now, keep in mind we're dealing with the May contracts here. So these are the May monthly contracts. So if I wanted to check my return on risk, remember you can do that pretty easily by just getting your calculator out, clicking confirm and send, and then taking the max profit, 22 bucks on one contract, divide it by max loss, 78 bucks on one contract, and you can see that it's a 28% return on risk. Now again, you have to account for the fact that our May contracts expire in 22 days, and so we're taking less risk than we would with a normal trade where we'd be in it for 30 days. And so I'm willing to go a little bit less than 30% return on risk, knowing that I'm going to be in the trade a lot less time as well in this particular case. So I'm going to come back over here, and I'm going to bump this up to a few more contracts. Let's maybe bump this up to, I don't know. Let's do 10 contracts. And the other thing that I'll point out, in case I haven't explained it thoroughly enough, I know we always have some new folks watching this, and not everybody is overly informed when it comes to option strategy. So just to take a step back and explain what we're doing with this type of a bull put spread is we're selling the 116.50 strike as the driver of our trade. The 115.50 that we're buying is the protection of our trade in case we're just flat out wrong. And remember, we will be occasionally. And so if this thing ends up, getting clobbered all the way down to 114 or 113, then that 115.50 put that we're the owner of can be exercised. And I just noticed that our credit went up to 23 cents. Kind of interesting there. So we're getting a little bit closer to that 30% return on risk nonetheless. The other thing that I'll point out is that this does not require a big bullish move. Yes, it's considered a bullish trade, but we could actually see the stock go nowhere and we'd be perfectly fine with it. Remember, TLT, which is a bond ETF, if I clean up my language there, it's not really a stock, it's a bond ETF, is trading effectively at 118 as it stands right now. So we're basically saying that for the next 22 days, we just want it to stay above 116.50. It could go sideways, it could go up a bunch, heck, it could even go down $1 per share. We would still win the trade. We just can't have it drop dramatically. So that's kind of the idea on that. And again, a big part of that is that bounce that we're getting out of it here today. So I'm going to confirm and send, and we'll see how that trade does for us. All right, well, thank you for checking out the Market Outlook video once again. Remember, if you get value out of these videos, make sure you're clicking thumbs up on YouTube, and then go on over to Twitter and give us a like and a retweet if you wouldn't mind. 138 of you did that last time, and I can't thank you enough for it. It does remind David and I that, yes, there's interest in these videos, and we should continue to do these on a daily basis for you. So with that, keep your eye on those stocks reporting earnings tomorrow. And there's a greater likelihood than not that we'll probably have an open to the market, but remember, that doesn't mean that we necessarily have to close open. So we're going to keep our eye on all those earnings stories and more as we go forward in these Market Outlook videos. David will be with you tomorrow, and I'll see you guys next week at some point as well. Have a great night, everybody. Best of success with your trades and your investments. Goodbye for now.